Ladies and gentlemen, Lord Stern is the keynote speaker and he will be moderating our next plenary as well on major waves in green finance. So please, a big round of applause. We welcome on stage Lord Stern. Welcome, sir. I'd also at this juncture request the rest of our esteemed panelists to please join us on stage for the next plenary. Welcome. Welcome, ma'am. Welcome, sirs. It's over to you, sir.
Thank you very much for introducing us, and I'm going to give I hope, fairly brief keynote address so that we have time to hear from our distinguished panelists and have a good discussion. But thank you to the IFC for getting us all together, particularly Sharif Friedman, who organised all this. And I am the I.G. Patel Chair at the London School of Economics, and it gives me great pleasure to recognise the Indian support for my chair, which is the RBI and the SBI and Yes Bank. Let me remind ourselves at the beginning of what we're trying to do. The world in Paris declared that we must try to, at least not must try, our objective is to hold global temperature increase in average global surface temperature relative to the end of the 19th century. We must try to keep that well below 2 degrees, and if possible, 1.5 degrees. And that was done on the basis of two things: a recognition of the immense risks from climate change. We haven't seen 3 degrees centigrade for 3 million years. And also the recognition that this was the growth story of the 21st century. We live in a world where there is plentiful saving and demand is short. By investing in sustainable infrastructure, by investing to implement the Paris Agreement, we increase demand and we sharpen supply in the short and medium term. We trigger innovation, creativity, investment, growth in the medium term, and we know that there is no long-term high-carbon growth story. It's a contradiction in terms. You create an environment so hostile that you can't grow. This is the growth story. It's very attractive. It delivers cities where you can move and breathe. It delivers ecologies which are strong and resilient. So it sounds as if this is win-win-win. Actually, it is. It is, but we have to change fast and radically to realize this. So this is a question of how do we realize these enormous opportunities which allow us to avoid the immense risks of climate change. But it's about radical change. It's about investing in different ways. Some industries will be dislocated. They have to be looked after and managed in that process of change. We have to bring new technologies and invest on the basis of them very quickly. So this is a story which is enormously attractive, but that doesn't mean it's easy. It means that we have to invest strongly. Most of this will be the private sector. Most of it will require finance, and that's exactly what we're discussing here, the major waves of green finance, to get moving this enormously attractive but also difficult set of changes that we have. As we recognized this morning, a big bulk of this investment, perhaps 2/3 of the investment, will be in Asia. A lot of it around infrastructure. So this is a story really of Asian infrastructure at its core, but of course not just infrastructure. There's so many other things that I'm sure we're going to be discussing here, buildings and so on. And behind all that, we've got the story of how the finance for all this works. What are the opportunities? What are the difficulties in getting the finance behind this really radical change? And that's the question that we want to be asking. And our panel will help us in trying to understand just what is involved, what risks there are, what opportunities there are in getting finance behind and fostering these really big changes. Now, for all this to work, you need a government policy framework. And we have to recognize it has to be a framework that deals, in my view, with 6 different market failures. Not just the big one. The big one is the greenhouse gases, that when we emit greenhouse gases, we damage others, and unless they're priced or regulated, that's a market failure. That's market failure number 1, and we should put it first. But research and innovation is fundamental in this area, and there, one person's research, one person's experiment is somebody else's knowledge. There's a positive externality there that we have to think about. We know that capital markets don't necessarily handle risks very well. There are many things that we ought to be managing there. That's a third area of potential market failure. Fourth, so much of this is about networks. It's about how cities function. It's about how public transport works. It's about how grid systems work. It's about how broadband works, about how we recycle. All these are networks, and they can only function with some kind of government policy. That doesn't mean government ownership, but some kind of government policy. Fifthly, this is an area where information is very important. And sixthly, it's an area of intense potential pollution. And in Delhi, of all places, I don't have to explain that particular problem. Of course, not all of Delhi's pollution comes from burning hydrocarbons, but some of it does, and that's an important part of any transition to the low-carbon economy. So I've given 6 areas where ordinary basic economics tells us that government policy is essential. And we can think through, and we've already been discussing what sort of government policy matters here. But this is a big part of the story, and as I emphasized this morning, it's very important for investment for that government policy not only to be sound in its principles, but be stable in its execution. Government-induced policy risk is the biggest deterrent to investment, whether it be green, brown, or tartan. We need clear, strong government policy, and I think the financial system is in a good position to press the importance of that. That's what governments can do. Well, what about the financial sector itself? Well, that's exactly what we're going to hear from our distinguished panel. As I mentioned this morning, the financial sector, in its interactions with government, can set out what it understands as good policy and the importance of stability. It's important that it be transparent in what it's doing. If I've got my pension and some pension fund is looking after my pension, I would want to understand what it's doing. And the pension fund would want to understand whether the areas it's investing in are very risky or not from the point of view of the progress of these green waves of technology. Is it investing in high carbon stuff? If so, it might be getting very risky. And we had the Task Force on Carbon Financial Disclosure report a year or so ago, and I know that Jonathan Drew is going to be saying something about that. The big pension funds themselves can follow policies which encourage real change. There was a very good example in AP4, the Swedish pension fund. It was a very big fund, and it had, say, a few retailers, it had a few car industries, it had a few airlines or whatever in its portfolio. It looked at each one, and it said, in that area, say retail, this firm is the most dirty, the most cavalier about climate change, environment, safety, or whatever, and it sold the worst one and said why. That gives you, that's not vulgar divestment, that's actually intelligent targeting which gives real incentives to people, and when it started following that policy, its risk-return profile improved. So that's another way in which the financial system can organize itself. It can use internal analytical techniques. The World Bank Group is embarking on the use of an internal price of carbon, as many good firms do already. And if you ask them why, well, those good firms will say, we're future-proofing our investments. We don't want to get caught as this policy moves more strongly to the delivery on Paris. Finally, and of course, there are new financial instruments such as green bonds. So there are lots of particular things which I know we're going to hear from, which the financial sector can do. Finally, there's the role of the multilateral development banks. I was 6.5 years chief economist of the European Bank for Reconstruction and Development, a regional bank, and 3.5 years as chief economist of the World Bank. So I might be biased in terms of what those institutions can do. But they are really important in this process. They can have very powerful multiplier effects. We've heard some of that already, and I'm sure we'll hear some more. The presence of a multilateral development bank makes government policy less likely to be volatile. When I was at the EBRD, we had a big firm that could have bought the EBRD at that stage. It was so big, but it wanted the EBRD in the deal because it felt that that would give more security in relevant government policy. A well-designed multilateral development bank has all kinds of instruments, equities and political risk guarantees and long-term loans that can help manage risk. A good multilateral development bank can convene other banks. It can get them together. You're more likely to go along to a meeting where you're trying to offer people different slices of investment if it's a multilateral development bank that rings you up than say, some private investment bank. I won't give an example of a private investment bank that might worry you if they offer you a slice of the deal. That convening power is very important. A good multilateral development bank acquires skills. The one I know best, the EBRD, is very skillful in energy efficiency. It's done a lot of work in energy efficiency. For all these reasons, a multilateral development bank can have very powerful multipliers. And that's absolutely key to getting investment on the scale that we need. They can be 1 in 4, 1 in 10, 1 in 20. It depends on the circumstances. But that multiplying up is a very powerful contribution to the scale we need. But that's enough from me. I'm looking forward very much to hearing our panel. And I'm going to sit down so I can feel part of it. And I'll ask people in turn. But let me just move from here to here. And I'm going to start, if I may, it's not sort of any kind of linear order, so I'm going to start with Jonathan Drew from HSBC. And Jonathan, if you could help us with a little description of the background that you come from and talk about whatever it is, particularly risks and opportunities, I think. But
certainly, Nick. Well, look, thank you very much, and thank you very much to the IFC for inviting me to join and participate in this session today. It's a great honour. By background, I am an infrastructure banker. Sustainable development, I would suggest, depends crucially on the development of efficient infrastructure. I'm also, within HSBC now, responsible for driving our sustainable financing business across Asia Pacific. So what is sustainable financing, or what do we consider sustainable financing to be? Well, very simply, it's really bringing capital to the process of and to support the creation of non-polluting, low-carbon assets that will deliver socially inclusive growth. And how do we do that? Well, we're not creating a new team. We're not going to create a whole new business called sustainable financing, but what we're really trying to do is to embed sustainability considerations in all of our businesses, all of our client-facing operations, and all of our support functions, and indeed the way we operate our businesses right down to our offices. Nick, in his introduction, talked about the extent to which commercial banks, as this huge process of climate change, as it were, bears down on us, face both risks and opportunities. I think conceptually risks to us are, yes, the risk of incurring a financial loss. There's also the possibility and a risk, if you can call it a risk, of incurring a financial gain. Let's not forget about the upsides. Obviously, as banks, most banks will have both physical assets and also financial assets. But if we consider perhaps what's the main component of the assets on our balance sheet, it would be those fixed return type assets, loans and so forth, where really the the risk would manifest, the climate change risk really manifests itself when the ability of our clients or the ability of an obligor to meet its financial obligations is impacted by climate change or sustainability risks. Within the context of the TCFD recommendations, again, which Nick referred to, so the Task Force on Climate-Related Financial Disclosure, which applies to all financial institutions, not just commercial banks, but asset owners, asset managers, and indeed any institution that is raising capital in the public markets. I think there's a very good definition of how some of these risks might be broken down between the so-called transition risks, so risks we face as regulation and policy evolves and changes, market risks, the risks we face as certain products and commodities may or may not become squeezed out of or driven into increasingly into economic activity, and of course reputational risks, risks that we all face if we are involved with business that is not considered to be acceptable business. And then of course the physical risks. Our clients face physical risks themselves, storm damage, flood damage to their physical assets, which in turn could lead to a change in their ability to service their fixed return debt type obligations. And this, as I mentioned up front, in terms of how we look at this, really affects all of our clients across all sectors. And I think we heard a number of very interesting explanations this morning and discussions this morning as to sort of how these risks are being addressed and the consequential opportunities being taken advantage of across interesting sectors from real estate and in the textile industry as well, and in the paper industry too. Now, in terms of assessing these risks, of course, the challenge is identify the risk, but then how do financial institutions assess these risks? In our view, one of the critical features in assessing the risk is actually the ability of the risk holder to manage those risks. So in a sense, addressing climate change, addressing sustainability is this huge change process that the entire economy is going through. And those best able to manage change are likely to be, from the banker's perspective, the best counterparts to be working with. So yes, looking at risk in different sectors is important, but I think it's difficult to underestimate the importance of looking at just the capability of clients to manage those risks. So that's a fundamental approach that we have embedded in our approach. And the other process point I would make around the assessment of risk is, of course, that as financial institutions, we have traditionally heavily relied on what I might call the rear view mirror to assess risks. But when it comes to climate change risks and sustainability risks, we can't really do that anymore, because those risks, they didn't manifest themselves in the past. We can't look at how they might be measured or assessed based upon empirical evidence. We have to be looking out the front window. We have to be looking where we're going. And again, clearly the TCFD has addressed this by strongly recommending that financial institutions now incorporate a very strong component of what they describe as scenario analysis into overall risk analysis. So this involves a totally new approach, really, to looking at risks, where we have to start looking forward and assessing, well, what would happen if certain policies and regulations were introduced? How would that affect the ability of obligors to meet their debt service obligations? How would our clients' financial statements be impacted if all of a sudden there were carbon taxes introduced at different levels and so forth? How would our clients' businesses be affected if public opinion suddenly turned to make certain business or certain activities no longer acceptable in society at large? So these are the types of look forward challenges that we face when we now have to address risks. And of course, TCFD, whilst it's established some general guidelines, published their recommendations in June of this year, they are very general. And TCFD is going to remain available for consultation, but it's now really handing over the reins to individual regulators to how those will now get implemented. and also I think a responsibility to market participants to show leadership in how we take the general principles and address those. And certainly from HSBC's perspective, we are very committed and determined to be a leader in that respect, but at the same time mindful that there are broader market considerations that we do need to be aware of. So very briefly to conclude on the opportunities, which is of course the other side of the risk equation. I mean, I put this very simply to my management when I'm seeking internal resource to support the initiative that I'm running. That we have, and Nick talked about these numbers this morning, huge volumes of investment happening today and increasing volumes of investment that will need to happen to deliver this sustainable growth. If we just picked a number of $5 trillion per annum, and as a project financier, I know, and other bankers in this room will know, that for every $100 of new asset we create, then the payments paid away for the provision of financial services to support that asset creation could be anywhere between $1 and $10 for each $100 of new asset created. So fundamentally, that's hundreds of billions of revenue opportunities for the financial services sector. So frankly, more than enough that should get every banker out of bed early every morning into the offices and engaging with their clients across all the sectors, from energy to resources to transportation to manufacturing to real estate, even through to the service sectors. All those areas will be affected. The opportunities are simply huge. And again, as Nick said this morning, 70% of those opportunities will likely be happening here in Asia. On the capital side, and when we look at the other part of our client base, of course, capital owners, whether it's the asset owners, the asset managers, are also hugely sensitive to this issue. 1,600 institutional investors now signed up to the United Nations Principles of Responsible Investment, with more than $70 trillion of assets under management between them, very focused on bringing capital to these transition and low carbon, low polluting activities. That's driven a whole flurry of new product opportunities, green bonds being one example again that Nick mentioned, but also product opportunities, creating investment opportunities, ESG-linked investment transactions and so forth. So an absolutely huge set of opportunities to go with a very significant set of risks that we need to manage at the same time.
Thank you.
Thank you.
Thank you very much, Jonathan. Lots of points arise there, and I hope there'll be time to ask one or two questions arising from that. But we must move on to our next panelist, PS Jayakumar, who's the MD and CEO of the Bank of Baroda, but also PS with lots of experience in all sorts of areas on the way to doing that, and including in very small or smaller lending to poorer people. So we look forward very much to you sharing your thoughts, please, PS.
Thank you very much. Just by way of introduction, I'm the CEO, Managing Director and CEO of Bank of Baroda, which is a state-owned bank and among the larger banks in the country. But prior to joining Bank of Baroda, and I'm one of the first people from the private sector to move to the government, I was working for about 25 years in Citibank in various roles, both here in India and elsewhere, and in which time I had a lot of work with IFC on a number of new initiatives, interesting things. But thereafter, I decided to wear an entrepreneurial hat, and I set up a company which was involved in construction of affordable housing, and which also incidentally happens to be which is also is an IFC investing company. And the question that was raised always is whether you could have low-cost housing, houses that cost $15,000 to $20,000, which can actually be energy efficient. And so we went about that goal, partly through the use of technology in the way the building intelligent management systems are designed today, that provides for enormous amount of computational capability that then results in a lot of environmentally sensitive decisions, including the way the buildings are placed, and also a lot of things related to what is lean manufacturing techniques. As we went through the process, one of the things we did was we are probably the first company in Asia to have the certification for a low-cost housing for what is called as an EDGE standard of IFC. And related to many other forms of certification that exist, and many of which I find it difficult to comprehend, what we did with respect to age standard was essentially a matrix of activities, intervention that you could do, the benefit they would provide, and the cost they would incur. And so then once you decided to allocate a certain cost for the effort relating to making the buildings environmentally efficient, which essentially means you would spend 50% less fresh water compared to the modal value, and will spend 67%, 33% less power compared to the modal value, then there is an opportunity to decide whether you want to use reflective painting or you want to put T3 fans, and then come with a combination where at $20 per square foot, we're able to achieve those objectives. So that was an interesting experience, and then I took upon the role of evangelizing this in the developer community. But I think but there aren't really any real funding available to developers in India for supporting any kind of green standards. They're generally viewed with a lot of suspicion, probably they deserve it, and so it is where it is. The second area is once I joined Bank of Baroda, we started working, looking at, obviously, our Prime Minister is a green warrior. There's a huge task set out with respect to solar, renewable energy, and various other things that he's pushing for, and the amount of money that's required is quite a lot. And so we have done our own part with respect to those activities, and probably we funded about 90 billion Indian rupees in these various initiatives, but they're pretty much like other things, so I don't want to spend time on them. But one of the couple of unique projects I want to discuss about, there's one with respect to financing as a social inclusion effort. So there is this, I want to imagine a place which is near the seaside, subjected to heavy monsoon, and which is essentially a marshland. And so during the monsoon period, the whole place gets flooded up with about 6 to 8 feet of water, and then the water recedes, and then the tribal people called the Agarias come over there and set the salt pan. And so for them, every monsoon, they lose whatever they've done, and every time they restart the activity once more. And there is a wonderful organization called SEVA, which have been working with the grassroots, especially in the area of women empowerment and women employment. And we then got partnered with them, and IFC had introduced us to SEVA, and also helped us in putting together the structure of the transaction, whereby what essentially we did was, apart from making finance available, we also worked with the CSR funds our customers have got, which would enable us to reduce the cost of funding. We then went another step further as we started engaging with the government. It seemed apparent that if we were going to make an order for a large amount of these panels and the systems, then there was a potential to reduce the cost by about 30–35%, just by means of better procurement relative to what an NGO could procure. So that became the next step. And then, obviously, the most important thing around it is around how do we get a fair price for the people so that income increases, and that's a separate subject. But one of the things that we chanced upon as we went about with our branch expansion is a kind of a prefabricated branches which can be assembled and disassembled, and very energy efficient solar panels, thermally insulated, and all of that stuff. And then we thought, why not take this, make this modification, provide housing to the same set of people. So then through a combination of these things, we can actually achieve both the green objective on one side and a significant improvement in the living standards because costs are reduced or the living conditions improve. So that's one area which has been interesting. The other area that has been interesting to me is this whole area around agricultural financing. Now, traditionally, the approach to agricultural financing in India has been a set of targets is set, gets stomped down, and everybody is discussing whether we meet the targets. But then now the discussions are around not about targets, but about how we make financial impact and how do we actually double the farmer's income, which is the goal that has been set by our Prime Minister. So as we start getting into that discussion, we've been trying to put together an ecosystem of micro-irrigation, solvable fertilizer, bringing together a bunch of people who are making efficient storage system and efficient logistics systems. And whereas we in this country are known for the financial tech industry started by young people, there's a whole sort of things happening in the real sector which are equally, if not more exciting. And so as we start drilling down that, one of the areas in which we can make a significant contribution is micro-irrigation, because it has got an ability to save water, at the same time provide more land available for development. But the challenge we have in our country is that drip irrigation is enormously subsidized, 90% subsidy. So the size of the drip irrigation market is decided by the extent of the subsidy. And in a sense, it's just acted against the desire to expand. So we now engage with one of the state governments saying that why don't we look at a bond that would effectively securitize the future set of subsidies they have it for the next 5 years and bring that investment forward, because the return to the farmers happen almost immediately, and then we can over a period of time get paid. And that notion is attractive to a lot of people because that ensures the money is not diverted, it goes for its intended purpose, and a bank could play a role in that. So a number of intervention variables which effectively have a green element component to it in form of power or in terms of soluble fertilizer or in terms of organic development, which we can bring together. And those notions are, to my mind, extremely exciting and things that we can work upon. Jonathan, you spoke about the risk, but let me tell you the risk as I see it in my role. And the risk is that not all organizations are at the same level of sophistication. And so what we need to do is to build greater capability around analyzing the environmental impact of the projects that we finance. And then how do we get ourselves to the same stage of evaluation, same stage of criteria building, intervention, et cetera, And so a lot of my effort now is to try to understand this subject and get ourselves better trained, get our lending officers better trained, and get a higher degree of sensitization around this subject. So that's one. And finally, we've been trying to work on getting a green deposit deposit. And as we look at our own segment of customers, we are very underrepresented in the younger segments. And these are things that attract the youth to making those kind of investments. When I say young people, I mean probably less than 35 years. And then we can provide real-time information as to what their deposits are doing in the context of contribution to climate protection. So this is one of the things that we're working on, fairly embryonic. The final point I wanted to make is that essentially any form of green bond financing in India, and I think we have raised about $3.2 billion till September 27 for this calendar year, against 82 billion or 84 billion, which I understand is the number overall, is that the cost of financing is not necessarily cheaper. And so some people would argue that we are providing credit to the segment, but in effect, there is no transfer of credit risk either in the transactions we have seen. So then that brings the notion of how do you get that reduction done. And it probably seems to me some of the things that we could do is to try to push the regulators to provide some benefits. We have a lot of mandated lending targets. We have capital adequacy requirements, and maybe there is opportunity to toggle with some of them to make those lending programs more effective, more green sensitive. That broadly is what I have to say with respect to what the area I've been working on. And obviously, I think the area of going down to the grassroots and then helping them, whether it is micro power grid or micro irrigation or solar power or any other form of mechanisms, and then figuring out a way in which you can bring in private money, you can bring in donor money, you can bring in a variety of things, and then drive the cost down, seems to be a very, very exciting opportunity to work upon and very fulfilling as well. Thank you very much.
Thank you very much, PS. And it leads very nicely into our next speaker, Usha Thorat, because you asked PS, how can the regulators help you make these new forms of finance, these new areas, acceptable, cheaper, easy to embrace by bankers. So, Usha, you have been right there in the center of things for a long time at RBI. Can you tell us a little bit about yourself and then how you see the role of the regulator in this rather new area?
Thank you, Nick, and thank you, IFC, for inviting me. Thank you very much. Yes, I was in the Reserve Bank for a long time. I stepped down in 2010, so it's nearly 7 years since then. And since then, I have been only, not that much involved with the financial sector. But I have been taking keen interest in environmental issues and in health issues by being associated with several not-for-profit entities. One of the organizations with which I chair is an organization called the Foundation for Ecological Security. It's based in Anand. And I want to tell you the story of one of their experiments in the Aravalli Ranges. A very male-dominated community in Rajasthan. Women are not allowed to participate in any village-level decision-making. But there is this K.C. Bai. She was elected head, Sarpanch, of the village-level institution. And she, the way she worked as the elected head, transformed how both women and men thought there about gender equality. She herself says of this change, "Earlier, we were not allowed to sit on the hatai, a raised platform around the tree in the center of the village, and even had to walk barefoot, carrying our slippers near the hatai, but today we sit alongside the men." How did this happen? It's a drought-prone area. The forests were all denuded. The rural economy is reliant on pasture land. The only options are livestock, supplementing subsistence agriculture. Water and fodder scarcity are the major issues for the community. When FES started working in this area, they started helping Kesibai mobilize women in the villages towards securing and restoring common resources. Women's groups have since then protected, restored, and managed huge acres of pasture land and reforested the forest there. The aquifers got recharged. There was better water supply for the entire area, including the downstream locations. And they were very mindful that there was no illegal boring of wells, and they used to be vigilant throughout the nights to see that nobody did that. There were community-driven collection rules and regulations to manage their pasture land, banning the cutting of trees, ensuring grass regeneration, preventing overgrazing, by simple rules in rotation and finding those who bypass these rules. Kesibai's efforts were catalyzed by FES using philanthropy money. It was perceived that restoration of natural resources working with communities have enormous externalities. It mitigates the impact of wanton and indiscriminate exploitation of natural resources. So if we look at forests, grasslands, wetlands, pastures as infrastructure which need to be protected to mitigate the impact of climate change, how do we then measure these benefits and actually convert them into revenue streams? Now, I think that is the question that can really make this whole effort sustainable. What is the role that governments can play, and what is the role of financial regulators? There was some discussion about how financial institutions make decisions. How do they make decisions, and the businesses they finance, how do they price carbon in their investing decisions? We heard some good examples from HSBC and Bank of Baroda. Nick also talked about how government policies, through fiscal policies and other policies, can make truly the real cost to society of protecting such infrastructure get reflected in revenue streams. So is it possible that we can think of a situation where Kesibai's activities in the forest in the Aravalli Hills can be compensated by a revenue stream out of user charges for water in the downstream areas? Another example I'd like to give is a Supreme Court decision recently to move towards a nationwide ban on the use of pet coke and furnace oil to power off industries. Now, this has put at risk huge number of assets of businesses using such fuels and the banks financing those assets. So how do we as regulators sensitize banks and financial institutions to such risk? As a regulator, we often ask ourselves, why do we regulate? Clearly, it is to protect depositors' interest, it is to protect investor interest, it is to ensure financial stability, it is for consumer protection, it is to prevent crime through financial institutions, so financial integrity. More recent objective of regulation has also become having a much more inclusive banking, and financial inclusion has now become a very important thing. But I think equally, a very important need for regulation is to ensure that the risks on account of the impact of climate change are properly assessed by the financial institutions and the businesses that they finance. The power of regulation is indeed huge and needs to be used. And how has this so far been manifest? It's been through a set of voluntary principles. The Equator Principles of 2003, RBI advised banks in India to adopt these principles. Now you have the disclosures on climate-related financial disclosures, assuming that the market is going to price the risk properly. Now we know that markets really don't price risks properly. And by the time these voluntary principles get accepted, as Nick is fond of reminding us, it just may be too late. So I think there is really an important thing that how do we really make Paris happen? It cannot be business as usual. It cannot be that the markets will take care of it, because private sector will go where there are incentives. there is a role of government, there is a role of financial regulators. In India, we've had experience with mandated credit. And in mandated credit for small loans up to 15 crores, all the activities that get labeled as green activities become part of priority sector lending. We have dealt with priority sector lending for a long time. And you can't, I mean, obviously, when 40% of loans are already given to agriculture, maybe it's time to think, what kind of agriculture? Is it agriculture which is creating more problems for the climate, I mean, for the globe as a result of climate change, or special kind of agriculture which looks at the impact and delivers a kind of agriculture? I think this whole thinking about the impact of climate change and the risk has to become internalized in the decision-making process of every business and every financial institution. But this cannot be done without proper pricing. As we discussed in the session on agriculture, when water and power are not priced for the Indian farmer, how do we expect agriculture to be friendly to, how can it be smart agriculture, climate smart agriculture? I think these are very essential, critical things which need discussion, which need sensitization. I mean, I am aware that here we have businesses who can take the opportunities which have been thrown up and can also look at the kind of risks which are getting disclosed by responsible businesses. But I think there is a need for much more to be done.
Thank you very much, Usha. You've clearly been spending your time after RBI very fascinating ways. Piers Stain from IFC, please tell us what you've been up to and what messages you have for us.
Okay. Thank you, Nick. Yeah, I've spent the last 2 decades working with banks and financial institutions in emerging markets. And 2 years ago, I took on our work with financial institutions on climate and climate business. And I've been involved in this over the last 2 decades, but I believe that the time has never been so opportune for banks to really enter into this business, and I think we see really a sea change happening. I'll just give you three points that we heard already a little bit of this from Jonathan as well as Jayakumar about how banks are getting much more engaged in their core business here. The first point really is that it is good business for banks, and we see this in the quite rapid growth of how banks are adopting this line of business. So in this year's survey of our client banks, 70% of all banks said that they are already active financing the green economy. And this is up from 61% last year, so pretty big step up year on year. And the top categories really are renewables, which we heard about, followed by energy efficiency, but then it's pretty broad. It is transportation, green buildings, waste recycling, water management, climate smart agriculture, so it covers a broad range. So it is good business. It's also, and that's the second point, it's a fast growing business. We then went into depth and did the largest survey in another region, Latin America, of banks there, and we saw that for those banks that are active in the space, 1/3 of the banks reported year-on-year growth rates of this particular business of more than 50%. Now, there's very few businesses that banks deal with that see this kind of growth rates quite consistently. And then the third point is, and I think we already heard this quite a bit about the wide range of what you can do in this, is really that it cuts across the whole spectrum of a bank's business. So whether it's retail banking, right, green mortgages, in the US are outperforming conventional mortgages, or I'm very much looking forward to Bank of Baroda's green deposits, right, where you go into that space, which we've seen resonate in China with Ant Financial's move into providing fintech-linked products for retail clients, but it cuts to commercial banking for energy efficiency financing, to trade, climate smart trade, to, of course, the traditional business of project financing and renewable energy, so pretty wide. And coming back to our original challenge and the challenge that you laid out, right? I mean, how can we really scale up the financing that's needed? clearly, no, we have to look at both the banking sector and capital markets, but for emerging markets, the banking sector still provides the majority of the financing of the economy, right? There's $50 trillion at work through banks. And so the more we can, of course, green and help banks seize that opportunity, the better. Of course, there's a link with the green bonds that we already heard about, which is a very fast growing segment, and we'll have a dedicated panel this afternoon to talk about it more, but it's clear that we have to support that business for the banks. One last point on the regulatory side. Also on the regulator side, we have seen a tremendous increase of interest in this space, right? 5 years ago, IFC helped set up the Sustainable Banking Network, which is a peer learning platform for regulators and banking associations from emerging markets. We started with 10 countries. It was started in China, and within 5 years, this has grown to 34 countries, covering 85% of total banking assets in emerging markets. And we've really gone from 0 to 15 countries that have already passed regulations similar to what Usha was mentioning, that are supportive and encouraging of both addressing risks and opportunities in the financial sector. And I think that combination of it's good business for banks and regulators are starting to really encourage this. I think that should help us accelerate how we put banks and capital markets to work to address the challenges for climate change.
Thank you very much indeed, Beer. I'm going to be quite quick on the questions from myself because we want to have a little time from the audience. But I'd like to ask really both Usha and Jonathan about voluntary codes. And we spoke about the Equator Principles, the TCFD, the Task Force for Climate-Related Financial Disclosure. Those are voluntary codes. How powerful can they be? Do I look bad if I don't comply with a voluntary code? Where are the sort of pressures in the market and the shareholders for those voluntary codes to really scale up and really catch on? Usha, you want to?
Almost all countries move towards global best practices because they are assessed against global best practices. So if you're Basel 1, 2, 3 compliant, then, in any financial sector assessment program, say by the World Bank or the IMF, then that becomes one of the areas where you get assessed. But I'm not so sure whether you have adopted Equator Principles or this disclosure norms, whether that becomes part of the assessment. Perhaps that is an area where one can, put some pressure on countries to adopt this and make their banking systems. Because when I look at the list, and I looked at the list of countries which have actually adopted Equator Principles, there's only one bank from India. And that's IDFC Bank, and there's no other bank there. So, so I guess the kind of network we are talking about brings in more pressure on banks to really start looking at it. And I found now hardly any banks in Asia actually were also there in that list. But that may not be that they're not sensitive to the need for mitigating these risks. But I think there is the kind of pressure that comes when you, the same kind of Basel kind of pressure is not there. That is what I would say.
Thank you, Jonathan.
Nick, I would say they are very effective. They can be very effective. I think the Equator Principles, the banks are required to report under those, or they've voluntarily agreed to report. If you don't report, or if you report inadequately, I think the banks feel that they are exposed to criticism. I think it does change banks' behavior. I think it does influence them to be more careful about where they put their capital at play. Another area we've seen voluntary codes in the green bond market, and now the social bond market, with the social bond principles coming out this year as well. I think the market has done a good job at developing those, tightening them over time, and the market, I think, is regulating itself quite well, and they are impactful because in some of those areas, and I think those two particularly, it would be very difficult really to replace those with effective legal codes and legal regulations.
So it may be the right thing at the right time that manages to catch a wave and really put pressure on those who are not conforming.
Absolutely. I mean, disclosure is fundamental to all of this. I mean, that's behind TCFD.
Yeah.
Green bonds are really about, it's the same as a non-green bond, except there's more disclosure. Equator principles, again, it's just about the banks explaining how they're dealing with environmental and social risks in the big infrastructure projects they're involved with.
Now, that kind of information from the TCFD and from the Equator Principles is really information that comes from the firm itself. But I was fascinated, PS, with the richness of your stories, where you didn't ask questions and wait for them to fill in a form and say, this is what we're doing. You seem to be very deeply involved in the detail of how the housing functioned or the activities in Sewa. Is that very costly on bankers' time?
No, I don't think so. I think the challenge in most of these cases is when you look at, especially at the grassroots level, is to be able to find a partner who then addresses a lot of things that we are not capable of addressing. As for example, evangelizing the idea to the group of people, and they have more credibility than we do. As for example, organizing them in a manner that for us giving the disbursement of the loan, the post-sanction verification, and a lot of other things becomes frankly easy. So I think if we do have a right partners, and there are many of them who are evolving, some obviously have done more and some others have done less, then the challenge to the bank is limited in terms of identifying right partners and creating a working model between them. So in the case of Sewa, our objective is to reach 15,000 households to enable them to get solar panels to replace. But the broader challenge is not our giving 15,000 people loan. That's relatively an easier challenge. It's about the panels, how do you get it, how do you put it, how do you get these people to be trained, how do you inculcate in them the responsible behavior of repayment. These are far more challenging questions if you ask me. And that part of it, if you have a great partner supporting you, then that work becomes that much easier.
So find a partner that you trust as a banker,
and the customers trust the partner.
And that partner is also trusted by the very small borrowers that it's dealing with. And the happy thing is that such partners exist, isn't it?
Yes. And the final thing is, even within your organization, you need people who believe in this cause and who therefore are willing to put that extra effort and willing to look at it far more sympathetically and far more involved.
Yeah.
So the challenge is also how do we get a large number of people engaged, and then because a lot of opportunities for us are local initiatives. If you talk about, for example, waste management, it's not something from Bombay we can spot these opportunities. There are a lot of local institutions spread in so many areas. Therefore, the consciousness of the people and their commitment would make a lot of difference. And so that's what we need to do, especially in a large market like India, large geographical market like India.
Thank you, PS. One question. You made it all sound absolutely splendid. It was all going swimmingly well and everything was growing and wonderful returns all round. Is that a bit strong? Or, I mean, don't bankers have to worry about things that go wrong?
No, certainly. So first I have to say we echo the discussion on the risk side, right? We always look at risk and opportunities. Of course, we're at the outset of the Equator Principles. We now put a very strong premium on risk management and clearly looking forward about climate risks. Now, Jonathan's point is right on the money, right? I mean, this is it's a different culture for banks to no longer use the rear view mirror, which has been ingrained in all risk models for banks. Now, in seizing the opportunity, there's huge challenges as well for banks and also for the still nascent green bond market, right? And now to start out with, this business is probably one of the most consulting and advisory intense areas. When we asked our client banks, do you use external help to kind of get into this business? Over 40% of them said yes, right? I mean, so that's clearly more than what we see in other segments, whether that's small business banking or banking on women or other target market segment oriented business lines. And the second point is that measurement is very difficult, right? So only 1 out of 4 banks is currently able to really measure the impact of that line of business. And that is key. That's key to making the link from originating loans that can then be packaged for the green bond market, because there you need to really report on the impact, right? And there's only very few countries, China, Brazil, that actually require the banks to report on this in any meaningful form. And that's clearly also an opportunity for regulators to now focus more on as well.
Very good. Thank you very much, Pierre. Now, we've got rather short time for questions. I'm just going to take 2 questions from the floor. I'll take them both together, then I'll ask our panelists for very brief responses. There's a gentleman just here. The lights in your eyes make it not so easy to see. One more question right after. Could you, just one moment, sir. Could I see any other question coming? Looks like there's just one question. Yeah, please.
My name is Pankaj Sindwani. I am part of Tata Cleantech, which is a JV of Tata Capital and IFC. My question is to Jonathan, and the question is, what's been your experience? You earlier talked about energy efficiency finance. Wanted to understand in greater detail what has been your experience with energy efficiency finance being part of HSBC. What kind of business models? Was it through ESCO route, or was it through mainstreaming of energy efficiency by lending to corporates? Because here in India, we find it really difficult. We are very keen to enhance our penetration in energy efficiency finance, but somehow the right kind of business models have eluded us. So wanted to benefit from your experience.
Well, it's one of those great questions where I think the answer was in the question, and I would 100% agree with you. It's very, very difficult, particularly to finance energy efficiency on a sort of what we'd call a project finance or limited recourse basis, because they tend to often be small-sized transactions. They may be employing technologies which are not so well known. There may be counterparties around the transaction who don't have a lot of financial strength to perhaps to support such a transaction, and the contracts themselves can be very complex. So you have to spend an awful long time dealing with the risk allocation, dealing with the metrics, allocating the payments based on the performance. So they are very, very difficult. I think what you've described, I would echo completely. It's clearly an important sector. It's often described as the sort of the low-hanging fruit of climate change, but I think mostly where we see it's effective is where you actually have corporates who step in, who are financially strong in their own right, and that's really the way that those transactions get financed.
Thank you, Jonathan. We're just about out of time, but I would like to ask you to thank our panel. They have been really extraordinary in the range of experience. We've gone all the way from very micro and the wonderful Self-Employed Women's Association, all the way up to the big infrastructure, down into another lesson on why when women are in charge it goes much better, wherever you look. When I was chief economist of the World Bank, we published a book, Engendering Development, which showed that everything led by women, whether it was repayment of loans, agricultural productivity, wherever you looked, if a woman was in charge, it went much better. And I'm sure that that lesson will stay with us. And we had it at the Self-Employed Women's Association too. So I think that's something we should note from this session. But it was a very wide and deep and thoughtful discussion, and I certainly learned a lot. And as an academic, if you learn something, you've had a good day. So I've had a good day. Thank you very much indeed.
Thank you. Thank you.